there are different ways to value stocks, but just being very simplistic, a very common way is the price to earnings ratio, right? And so the stock price can go up largely based on one of two things. Either the earnings go up, right? And you have whatever your PE ratio is times those greater earnings, and that gets you a higher stock price. Or the earnings remain the same, but the multiple goes up, that people just get more confident about the company's future prospects and say, instead of paying 15 times earnings for this, I'm willing to pay 20 times earnings for this, right? And that can drive the price higher. You're basically saying we've got historically high multiples, right? So those are likely to mean revert. So meaning the multiple itself may come down. And you're saying that profit margins are likely to mean revert, meaning that the earnings will come down. So it's, to your point, it's like a double barrel shotgun of pain in each barrel.
Yep.
Now the question is what period does that unfold over? And, are they together? Does it one happen first and second? There are other things, other factors that moderate that. But at a very high level, your expectation is that we're going to see multiples come down and we're going to see earnings come down as at least as a percent of profits.
Yeah, and to your point, Adam, there are lots of ways to measure earnings, multiples. And the question, we think the most legitimate ones are the multiples and valuation multiples that have the highest statistical correlation as to forward-looking returns, say over the next decade. We've shared, and I know there's others on your program have shared charts showing kind of, hey, when valuations get to these levels, the 10-year subsequent returns look pretty darn poor, if not downright negative, right? Those aren't looking at year ahead, 12-month forward estimates on earnings. Those are looking at things like the cyclically adjusted Shiller PE ratio, which takes 10 years of earnings, smooths it for inflation. This all gets to the point that when you buy a stock, you're not buying it based upon a discounting cash flow over the next year. Who cares what the next year is? Really, what does the next 20 years look like for this company? That's the way companies should and are fundamentally valued. Now, the market sometimes ignores that and says, hey, the cabal of analysts on Wall Street say earnings are going to be this next year, and they take that as gospel, conveniently forgetting that the track record of analysts for predicting earnings, certainly on a year ahead basis, is abysmal. They're either always way too low or way too high, or just rarely get it right. So to put such blind faith and year ahead, forward 12-month earnings estimates as the basis for PE is just really short-sighted and absolutely has no really strong correlation with subsequent returns over the timelines that matter for most people like our clients.
Yeah, and I think it also is important too, the title of Jesse's piece that I kicked the interview off with was this paradigm shift, right? From globalization more towards mercantilism, nationalism, protectionism, et cetera, which, and folks, if you've seen past interviews I've done with the likes of folks like Michael Every, they argue that, hey, that's been the way of the world pretty much since time immemorial. And globalization was the aberration, and that period now is swiftly coming to an end. So the companies that benefited the most from globalization to be able to use low-cost manufacturing in foreign countries as a way to demand higher multiples in their stocks, those are the companies that are probably likely that are going to be injured the most going into this new era. And Jesse, as one example, mentioned Apple, which is a company that has barely grown revenues in recent years, right? But has still maintained a very rich stock price as more and more of their manufacturing gets either reshored or at least moved out of China. That's one that perhaps may have a pretty big target on its back, right? So that's another thing you got to keep in the mix here, is not just where are we on sort of historic valuation extremes, but are we in a new regime that may actually pull some of these things down even more so?
Yep. No, and in fact, I was going to mention, I think was it Felix Zulauf you had on a couple weeks ago that spoke to exactly that, and he used Apple as an example. Huge profit margins, largely the result of offshore labor, but also some pretty sweetheart tax deals with their offshore entity in Ireland.